Hello, hello, hello. My name is David McGard. This is Property Value. I talk about commercial real estate focused on South Florida. Big day today. Feds are expected to say how much the rate's going to go up. Everyone's anticipating 25 bips. But let's get into the first headline. Oh, that wasn't so great. Let's try that again. And by the way, today is March 16th, 2022. 10-year Treasury yield tops 2.16%. Ahead of the Fed decision today, the 10-year Treasury yield topped 2.16 on Wednesday morning. Let's put that up. There you go. On Wednesday morning, yesterday, with the Federal Reserve expected to announce its interest rate hike today. The yield on the benchmark 10-year Treasury note climbed less than a basis to 2.162. The yield on the 30-year Treasury bond was flat at 2.495. Yields are more inversely to prices, and a 1 basis point is equal to 0.01%. Says the 10-year rate, this is CNBC, the 10-year rate has surged since the beginning of the week, ahead of the Fed's latest policy decision. The Fed is expected to announce that it will raise interest rates by a quarter point on today, Wednesday, March 16th. The first hike since 2018. Watchers also anticipate that the Fed will offer a new quarterly forecast that could indicate 5 or 6 more hikes this year. 5 or 6, they say. The central bank is set to announce its decision and economic projections after its 2-day meeting wraps up today at 2 p.m. with Fed Chairman Jerome Powell then due to give a briefing. ING strategists said in a note on Wednesday that they expected that the Fed implement 0.25% point rate hikes in 2022 and 2 more in 2023. They said it was important to note that the role that the central banks had influencing long-dated interest rates. In all likelihood, a more hawkish Fed, for instance, moving its dot plot to close to the number of hikes we're expecting in the cycle, would push rates higher, the strategist said. Russia's invasion of Ukraine also remains in the focus for investors, with negotiations between officials set to continue on Wednesday. Ukraine President Zelensky, he said securing a peace agreement with Russia is beginning to sound more realistic. Well, that's a good news. Russia faces the possibility that it could default on its debt for the first time in decades, with 2 payments totaling $117 million due on Wednesday today. In terms of the U.S. economy data releases due out today, February's retail figures are set to be released 8:30, along with last month's import and export prices. The National Association of Home Builders March Housing Market Index is then due out at 10 a.m. An auction is scheduled to be held on Wednesday for the $35 billion of 119-day bills, and that comes from CNBC. Next on the plate, see what it says about Ukraine. What's going on? Ukraine invasion. Rising interest rates add pressure for home loan firms to cut workers. Layoffs follow drop in new loans as commercial real estate industry watches for warning signs. This is by Mark Heschmeyer, CoStar News. 2 big layoff disclosures from residential real estate finance firms, Better.com and PennyMac Financial Services, are among the first in the property lending design to confront mounting economic pressure elevated by Russia's invasion of Ukraine and rising interest rates. The number of home mortgages has fallen steadily since last fall, when homeowners and home buyers started to worry about higher rates, according to the Mortgage Bankers Association. That comes after home lenders had beefed up staff to meet record demand for homes and refinancing when the Federal Reserve lowered borrowing rates to near zero to offset the economic damage from the coronavirus. Now many homeowners are overstaffed as demand dwindled. Whether layoffs spill over into the commercial mortgage side of the real estate financing remains to be unseen, but analysts are keeping a watchful eye on how long the war goes on and how high and fast interest rates rise. Commercial real estate capital markets have a larger cushion when it comes to the fallout from the market volatility and inflation, according to a new analysis from Marcus and Millichap. I quote, in light of an added uncertainty, lenders have begun to assume a more cautious stance, analysts at the real estate brokerage wrote last week. Again, thus far, the movement has not been significant or broad based, but if the war in Ukraine escalates, either military or through cyber attacks, lenders may adopt a more conservative posture. Interest rates would have to rise by more than 1% before a substantive share of investors begin to rethink their acquisition strategies, the firm added. That's a big hill to climb. The Federal Reserve is expected to raise rates by 25 bips today, Wednesday, March 16th. New York-based residential mortgage firm Better.com announced efforts to streamline operations last week. Better.com told CoStar News a little more than 3,000 people will be let go. PennyMac, a publicly traded mortgage firm in Westlake, Virginia, California, filed 4 notices with California's Employment Development Department disclosing about 140 layoffs. PennyMac officials did not immediately respond to requests for more information. These 2 announcements come on the heels of Stearns Lending laying off 441 Texas employees in January. The residential real estate market has been changing rapidly, and our entire industry is facing a dramatic drop in origination volume due to rising interest rates. Kevin Ryan, interim president and chief financial officer of Better.com, said in an email to his employees last week, a copy of which was shared with CoStar News by the company. It is clear, after careful, comprehensive review, that we will need to do more to ensure a strong path forward for the company and the vital work we are doing to make home ownership more accessible for everyone. Better.com is the same company that drew notoriety early in December for unceremonious announcing over a Zoom call that it would lay off 900 people. Last week's layoffs are in addition to those. Layoffs will occur in the United States and in India. We have huge opportunities ahead to grow and serve, but we must adjust to volatility in the interest rate environment and refinancing market to get there successfully. This decision is driven heavily by the headwinds affecting the residential real estate market, Ryan wrote. A majority of mortgage lenders expect to see profitability decrease in the near term amid the rising rates and declining refinance activity, according to new sentiment survey from housing finance giant Fannie Mae. For the 6th consecutive quarter, mortgage lenders expressed bearishness about new term profit margin expectations amid headwinds for declining refinance activity, slower purchase mortgage demand growth, and narrowing spreads, Doug Duncan, Fannie Mae's senior vice president and chief economist, said in a statement. For consumers, rising interest rates, lack of supply, and strong home price appreciation have reduced refinance activity and further constrained home purchase affordability, which, of course, is dampening lenders' expectations of future business activity. Those trends are now joined by other uncertainties, including heightened inflation, particularly in the energy sector, from the impact of the Russian war on Ukraine, which is likely to increase market volatility, Duncan said. The MBA's Market Composite Index, a measure of mortgage loan application volume, has been showing declining activity for most weeks since last August, when talk of higher interest rates first began. As of last week, the MBA's refinance index was 50% lower than the same week a year ago. Its purchase index was 7% lower than the same week of the previous year. Here's a picture of the index. And as you can see, the trend is going down. Had a little spike here in March. So Ukraine throws an additional volatility into what's happening with bond yields and rates in general. But we are anticipating about 33% drop in dollar originations altogether, going from 3.9 trillion down to over 2.6 trillion in refinance volume. Marina Walsh, vice president of industry analysis of MBA, told CoStar News in an interview, "We don't know what's going on to happen with Ukraine's situation, but we are anticipating that inflation really is going to put upward pressure on rates. Other mortgage firms talked about cutbacks in the industry in their fourth quarter earning calls. If mortgage origination falls as MBA anticipates, that increases the pressure on mortgage industry to cut expenses through layoffs or increase expenses to attract new business. Anthony Heisch, founder of CEO of Loan Depot, said on the earnings call last month, the MBA expects mortgage volumes to decrease by 35% this year. This is neither unexpected nor unprecedented, Heisch said. What makes this one unique is that this may turn out to be the first sustained market decline since the passage of Dodd-Frank in 2010. Many of our competitors have not been tested during both the significant market downturn and a more restrictive regulatory environment. Many of our competitors may find it difficult to grow or even maintain their volumes without significant increase in customer acquisition and marketing cost. That goes for the rate hikes, invasions, Ukraine. Now, let's go over to South Florida. We had a program called EB5, which I believe went off the books for a little bit, but it says the EB5, and this is from South Florida Business Journal. The EB5 Immigrant Investor Program is making comeback. Here's what it means for local developers. A visa program that allows investors to buy into real estate projects in exchange for green cards is close to being revived, and it could provide another source of capital for South Florida developers as costs rise. The EB5 program enables immigrant investors to obtain U.S. residency if they help fund projects that create at least 10 jobs in the United States. Regional centers, which facilitate these transactions, could back real estate projects or other business ventures with EB5 investments until June 2021, when the program lapsed. But on the night of March 10th, the United States Senate passed H.R. 2471, an omnibus bill that mainly dealt with Ukraine and Haiti, but also included provisions to reactivate the defunct EB5 Regional Center program. As of the deadline, the bipartisan bill is awaiting President Joe Biden's signature. Ronald Fenstone and Rohit Kapruni of Philadelphia headquartered law firm Swall Ewing, Arnstein and Lars said regional centers attracted $44 billion in capital for real estate developers and businesses across the United States. Fieldstone, who works out of Saul Ewing, Arnstein and Lars' Miami office, said in the past 6 years, he and Caprini represented more than 18 large South Florida-based EB5 funds that altogether raised $2.5 billion. They now represent 8 South Florida real estate developer clients who are eagerly awaiting the reactivation of the program. There will be a resurgence of some degree of large projects across the board in South Florida using the EB5 program for financing, Feldstone said. But the regional center program, now set to expire September 30th, 2027, has changed. The minimum investment amount to obtain a green card through the program has been raised to $1.5 million from the previous $1 million for most parts of the United States. For regional centers investing in projects within designated high unemployment areas, the new minimum investment is $800,000 instead of $500,000. That's a $300,000 increase. Ronald Klein of Holland and Knights LLP Miami office said the new legislation also includes language that will help prevent bad actors from taking advantage of the program. In the whole history of EB5, most regional center projects have been very successful, said Klein, who represents U.S. Immigrant Fund at Boca Raton-based regional center. In the past, it was Chinese nationalists who mostly pursued EB5 visas. But this time around, Caprini of Saul Ewing's Chicago office predicts many of the applicants will come from Latin America, India, and Vietnam. We will see a surge from Latin America for sure, Caprini added. It's possible there will be a surge in EB5 applications from Eastern Europe too. Given what's going on in Ukraine, I expect to see some rise in the numbers of visas there, Caprina said. So, EB5 coming back, or hopefully, or at least it's on the books to come back. And for the last article today, it's by The Real Deal, South Florida Real Estate News. And the headline says Chateau Fortune launched sales of 2-tower St. Regis in Sunny Isles after sellout of nearby project. The developers launched sales of South Tower first, with pricing starts in $3 million. These are sales for condo towers in North Miami Beach. Edgardo Dufontaine and Manuel Grosskopf launched sales of their latest oceanfront luxury condo development in Sunny Isles Beach after selling out the Ritz-Carlton residence project nearby. Dufontaine's Fortune International Group and Grosskopf's Chateau Group plan to build the St. Regis Residences, a 2-tower project at 18801 Collins Avenue. The developers told The Real Deal. Prices start at about $3 million. The Sunny Isles Beach City Commission last month approved the developer's site plan modification that calls for the two 62-story towers with up to 490 units, as well as a private members club. The developers are beginning with sales of 62-story South Tower, which will have 194 units. Each tower has an expected sellout of about $1 billion. Di Fortuna, president and CEO of Fortune, said the developers plan to launch as soon as we were ready. Because of the market demand, buyers can reserve units and will later enter into a contract. It's all about market conditions, said Grosskopf, Chateau Group CEO. We are in a strong market. Fortune and Chateau also recently sold the remaining units at the Ritz branded tower at 15701 Collins Avenue in Sunny Isles Beach for a total sellout of about $8 million. Last year, a penthouse there traded for that was a total sellout of about $800 million, close to $1 billion. Last year, the penthouse there traded for $25.5 million, or about $4,200 per square foot. Like other developers, Di Fortuna and Grosskopf said more units were purchased by Americans as opposed to foreign buyers. Over the past couple of years, more than half, $440 million worth of sales at the Ritz were to U.S. buyers, they said. That resulted in larger units and more amenities at the St. Regis. We're really experiencing probably the best market I've ever seen in my 30-year career in terms of balanced market, Di Fortuna said. Both St. Regis and the Ritz-Carlton are Marriott International brands. Related Group and Integra Investments recently began selling the St. Regis Residencies Miami development in Brickell. Di Fortuna and Grosskopf said the timing worked out for the St. Regis Sunny Isles launch. They're part of a growing group of developers racing to launch sales of new projects to capture as much market demand as possible. In Sunny Isles, the only other high-profile development to begin sales recently is the Desert Development's Bentley residence at 18401 Collins Avenue. Prices there start at close to $4 million. Fortune and Chateau spent years assembling their 4.7-acre development site for the St. Regis project, spending $113 million to buy out close to 350 individual owners in 2014. That was almost 10 years ago. The property was previously home to La Playa de Parvorto Condo Hotel. It has 435 feet of ocean linear frontage. 2 years ago, they secured a $119 million loan for the site. Bank Ozok provided their financing. Miami-based Arquitectonica is designing the towers, which will connect, and San Paulo-based is the interior designer. The development will include about 70,000 square feet of amenities, including oceanfront, sunset pools, a restaurant, wellness center, spa, and fitness center. Units will have 2 to 3 bedrooms, ranging from $3 million to $10 million, with most averaging about 5 million, the developer said. Fortune and Chateau plan to open a 7,500 sales center within the next 3 months, Grobschroff said. That was from Catherine Calgeris of The Real Deal, talking about what's going on in Sunny Isles and what's selling out. So we'll figure it out what's happening in a little while on the raising rates of the Feds, and if the 2.5 bips is right, and whether the Fed chairman Jerome Powell will continue throughout the year raising the rates. I'm David Magard. You've been listening to Property Value. Have a great day. March 16, 2022. See you tomorrow.